If you're doing your own self-assessment tax return every single year, thinking that it's straightforward, let me show you how you're probably leaving £2,000 to £5,000 on the table every year. I'm Mustafa and I review hundreds of self-assessment returns every single year, and I see these same expensive mistakes happening consistently. Let me show you what you're missing. Look, I totally get it. You're a business owner. You think you're capable enough to just file a simple tax return. How hard can it really be? So you do it yourself, you save a couple of £100 in accountancy fees, and you think you're all good. But here's what you don't know. Most people who do their own self-assessment return leave thousands in unclaimed deductions. You make expensive errors and you pay way more tax than you actually need to. And if this is you, you likely have no idea that you're actually doing this. So here are the 5 mistakes I see happening constantly, and I'm going to show you what they're costing you as well. First mistake, home office expenses. Now most people think this is the easy part. £6 a week, flat rate deduction, I've done my job. I've claimed what I need to claim. But here's what you don't realize. That £6 a week, £312 a year is the minimum option. It's the bare minimum that HMRC allow you. And for most business owners, you could be claiming significantly more than that £312. And the method you can actually use is called the actual cost method. Let me show you the difference between the two. So the flat rate method, as I've said, is £6 a week, 52 weeks, is £312 a year that you can claim. It's simple, but it's probably wrong for you. So with the actual cost method, let's say your total household bills are around £15,000 a year. To break that down, you could have your mortgage interest or your rent, call that £9,000, council tax a further £1,800, utilities, internet, building insurance, yeah, it all adds up to about £15,000. Now if you use one room in a 5-bedroom house exclusively for business, that's 20% of that total cost you can claim back. So 20% of £15,000, that's £3,000 you can claim back. Now compare the two, £3,000 versus £312. See the difference? You've just left £2,688 on the table by using the simple method. And most people who do their own tax return simply have no idea that this actual method exists. They tick the simplified expense box and think they've done their job by claiming the £6 a week allowance. But here's the catch. You need to actually calculate this figure properly. You can't just guess percentages. You need floor plans, you need measurements so that you can actually have something backable in case HMRC question you. And that's why most DIY filers don't bother going down this route. It seems like hard work. They either don't know it's an option or they think it's too complicated and just stick with the simple. But that too complicated mindset in this example has cost over £2,688. Think about that. Mistake number 2 is vehicle expenses and mileage. Everyone knows you can claim 45p per mile for business use. So what most do is think, great, I'll estimate my mileage at the end of the year and I'll claim that back. First problem, you're estimating. HMRC want actual records, dated travel records, to and from, reason, and so much more. And if you can't prove that journey ever existed, you can't claim it. I've seen people claim they've probably done 5,000 miles a year. But in reality, that number's more like 8,000. That's 3,000 miles unclaimed. And at 45p per mile, that's £1,350 left on the table. But here's the second problem, and here's where it gets a bit more interesting. Most people don't know you can claim for mileage for more than just client meetings. You can claim for traveling to suppliers, traveling for networking events, travel to the bank for business purpose, traveling to purchase any business equipment, and traveling to training courses. Of course, there's a lot more as well. As long as it's business travel and not commuting to and from a workplace, it's claimable. I had someone last year who was only claiming visits to clients, and that was around 3,000 miles. And when I actually reviewed their records, I found a further 4,000 miles there, which were for other business purposes, but they didn't realize that they could actually claim that. That's an extra £1,800. Just like that. It was just sitting there and it was unclaimed. And here's the third issue. If your mileage is high enough, you may be better off claiming the actual cost method. If you're doing over 15,000, 20,000 miles a year, claiming actual costs, things like fuel, insurance, repairs, maintenance, servicing, even depreciation, it might save you a lot more. But you'd never know that if you're just ticking the simple box on HMRC's portal. Now let's move to mistake 3, capital allowances. This is where most DIY filers simply crumble. And it's because HMRC's self-assessment portal doesn't actually make this quite clear. Here's what happens. You buy a laptop, let's say £1,200, and you buy some office furniture for £2,500. You think it's a business expense and put it all through as costs in your P&L. Then HMRC turns around and says, no, it's a capital item. And that's where most people will start to panic. Capital does not mean non-deductible. It's just a different form of claiming. The fix for all that is capital allowances, and mainly AIA, the annual investment allowance. The problem is that the self-assessment form that HMRC have made never actually breaks any of this down clearly for you. So what people either do is they don't claim it at all, they end up expensing it incorrectly, or they end up choosing to claim the £1,000 trading allowance as the simpler option. Now let me explain that last one, because that's a massive trap. HMRC offers a trading allowance of £1,000. This means that if your expenses are under £1,000, you can simply tick that box and have a claimable expense. It sounds great, you've got a free £1,000, but if you claim the trading allowance, you cannot claim any other actual expenses. It's either or, you can't have both. So if you've actually spent £8,000 on legitimate business expenses and you tick that box, you've just lost £7,000. And I see this every single year. People think that the trading allowance is a bonus on top of their expenses, and they get it wrong. And chances are, if you're doing it yourself, you probably didn't even realize this too. Look, if you're watching this thinking I've definitely made one of these mistakes in the past years, or you're simply not sure if you're claiming everything possible, click the link in the description, book a call in with me. We'll go through everything, give you a clear path on how you can actually save some tax. There's no pressure, just clarity. Mistake 4 is that you're missing allowable expenses. This one is a bit broad, I understand, but it's where most DIY filers lose the most money. It's because unless you're an accountant yourself, you likely don't know what's tax deductible and what's not. Here are expenses that are tax deductible and most people forget to claim. Professional subscriptions. We've got industry body memberships, trade magazines, LinkedIn Premium if you like to go down that route. Most people pay for these things and forget. Training that you take to be a better businessman, be better at your trade, all deductible. Any courses as well, deductible. Webinars, any books you've bought, again, deductible. Any business bank fees, any interest on any loans you've taken for the business, any merchant fees. People seem to forget that these actually exist. Marketing and advertising, you got your Facebook ads, Google ads, LinkedIn ads, business cards, logo design, your website, so many things. Even the cost of your accountant is claimable. Your solicitor costs, any business insurance that you've taken out, a professional indemnity insurance, all these things and so much more are deductible. Now here's the thing, if I went through and added up all these little things, they may cost £20 to £50 each. But if you add them all up over the course of a year, you'd probably be anywhere near £2,000 to £3,000 in unclaimed expenses. And at 20% tax, or even 40% if you're a higher rate taxpayer, that's £400 to £600 extra in tax that you're paying every single year. And the reason you're missing all these expenses is very simple really. You're just not tracking anything. You get to January, you're rushing to file, you quickly scan through your bank statements, you think you've remembered everything and you push it through. You claim the obvious stuff like your rent, your bills, things like that, but all the little small stuff, it all goes forgotten and it all adds up. Now on to the final mistake, and this is a big one for limited company owners. You're not optimizing your salary versus dividend split. If you run a limited company and you're taking everything out as salary, or as dividends, you're making a mistake. It could be costing you so much more extra in tax every year. So here's the optimal structure for most limited company directors from the tax year 25-26 onwards. So let's say you want to take £50,000 out of your company. Sounds like a good salary. Option A, if you take all salary, let's say the £50,000 is fully done through PAYE. You're going to have income tax about £7,486, employee NI at £2,994, employer NI at £6,750, so your total tax and NI cost is going to be about £17,230. So the cost to the company is going to be about £56,750, and you're going to receive, after all of that, £39,520. Now instead, you could go to the optimal split, which is option B. This is where you take salary at £12,570. You will receive £12,570, no deductions made from that, as it's tax-free. Then you're going to top the remainder up, £37,430, to get to that £50,000 in dividends. So dividend tax is going to be about £3,231. That's 8.75% of dividends that we've just taken out. And just to put a pointer out there, you get a £500 allowance, which is tax-free. So what this means is you now get £50,000 total. However, the cost of the company is only £51,135.50. The total tax that you're going to pay let's say employer's NI again, at £1,135.50 plus the £3,231 in dividend tax. So the difference between the two options is that option A is going to cost you £56,750, whereas option B is going to cost you £51,135.50. That's a saving of £5,614.50. It's the same £50,000 taken out personally. However, the tax difference is big. Now, most people who do their own tax return don't know that this split exists. So they end up just taking it all out as salary or all out as dividends. You likely don't even know how to calculate it properly, even if you was to go down the route of apportioning. Or you don't even know how to implement it. You've got payroll, you've got dividends to account for, and so many other things. So they end up paying themselves randomly throughout the year and end up overpaying thousands in tax every single year. So let's go back and add all of this up. Mistake number 1, your home office. That was £2,688 left unclaimed. Mistake number 2, mileage. That was a further £1,800 left unclaimed. Mistake number 3, call it £2,000 plus in unclaimed capital allowances. Mistake number 4, again a further £2,500. And mistake number 5, £5,600 in overpaid tax. That works out to over £14,500. Now look, I understand you're probably not making every single one of these mistakes, but even if you're making 2, that's £2,000 to £3,000 in unclaimed deductions. And if you're doing that year after year, you can do the math. Meanwhile, you think you saved a couple of £100 by not hiring an accountant. That's not saving money, that's expensive. So if you're watching this and thinking, I've done this completely wrong, you now have 2 options. Option 1, you carry on doing it yourself, thinking that you're saving a couple of £100, but losing £3,000 plus in opportunities. Or option B, you reach out to us, you book in a discovery call, the link is in the description, where we can go through your situation, map out a plan which allows you to save tax and be more confident in your numbers. We'll review your last return, we'll show you what was missed and how much you could actually save in the coming year. Because here's the truth, a good accountant doesn't just cost you money, they actually save you money.